Well, it's a killer. The SPACs generally have to spend their money in 2 years, as I understand it. So they have to buy a business in 2 years. If you put a gun to my head and said you got to buy a big business in 2 years, I'd buy one, but it wouldn't be much of one.
I call it fee-driven buying. In other words, not buying because it's a good investment. They're buying it because the advisor gets a fee. And, of course, the more of that you get, the sillier your civilization is getting. And to some extent, it's a moral failing, too. Because the easy money made by things like SPACs and total return derivatives and so on, you push that to excess, it causes horrible problems for the civilization. And it reflects no credit on the people that are doing it and no credit on the regulators and voters that allow it. So I think we have a lot to be ashamed of in current conditions.
Can I just say that's why these gentlemen are national treasures? I'm just saying it for what it's worth, because they tell the truth. Warren Buffett and Charlie Munger speaking out on SPACs over the weekend at the Berkshire annual shareholder meeting. The SPAC market coming under a lot of pressure, now facing another potential threat. President Biden's new tax proposal. Leslie Picker has more on that story right now. Leslie?
Hey, Andrew, that's right. Bumping the tax rate that the wealthy pay for capital gains could have a, quote, major effect on SPACs, tax experts say. The Biden plan as it stands would nearly double the tax rate for capital gains to 39.6% for those making more than $1 million. For SPAC sponsors or those who manage the SPACs, the one that Buffett was saying gets a lot of fees, this subtracts more of their potential windfall. In exchange for arranging the SPAC or special purpose acquisition company, sponsors are given founder shares in the vehicle for basically a nominal amount. And these shares often represent 20% of the SPAC's capital, which can be worth tens of millions, even hundreds of millions of on-paper profit in some cases, even more so once that merger closes. Now, sponsors are usually locked up for a period of time after the deal is closed, so their window to try and time any sales at the current lower rate is fleeting. The same dynamic may alter the game for companies considering selling to SPACs as well, given that it's likely the executives would be facing higher taxes, although that may be true regardless of who the buyer is. Regardless, it is a very competitive market for these companies to be selling to SPACs right now, as those two mentioned earlier. Now, SPACs have been hit over the last month in large part thanks to regulatory uncertainties, so any change in capital gains taxes could add salt to that wound, guys.
Leslie, I have not focused on this tax issue enough. If you are a SPAC sponsor, is that stake considered effectively the equivalent of a carried interest historically?
It's very similar. It's very similar. So I was speaking to tax experts. It can be murky. Some people do say it's ordinary income and it should be treated as such. But by and large, the vast majority of SPACs do treat it as capital gains because they basically have taken these stakes in the SPAC vehicles and they have ridden them up to the upside and are able to pay capital gains rates on those profits as a result.
Shepard Smith here. Thanks for watching CNBC on YouTube.